Chapter 3, Part 1, Accounting and Finance. Following are the learning outcomes. After going through this presentation, student would be able to interpret the details of a balance sheet with respect to assets and liabilities. Also interpret the dynamic nature of balance sheet, how it changes with time and with different market conditions. Analyze income statement of firms with respect to revenue and cost and profits, etc. Analyze a state. Later on, they'll be also able to analyze statement of cash flows and look at personal and corporate income taxes. In this presentation, let's focus most of our work on balance sheet though. So a balance sheet is a financial statement that shows firms' assets and liabilities at a given point of time. And as the definition itself suggests, as the point of time changes, balance sheet changes as well. And the most important thing in a balance sheet is to determine the shareholders' equity or owner's equity, or the money that is accrued to the owners of the firm in case the firm is liquidated. And that is defined as the total assets minus total liabilities. We'll be defining what's asset and what's a liability in just a little bit. So, an asset is something with respect to which if we break the relationship of the firm gets paid. For example, plant and machine. A firm that owns a plant and machine, if we break that relationship, as soon as the plant and machine are liquidated or sold off, the firm gets paid. And that's called an asset. On the other hand, let's assume that the firm has taken a loan. So if that relationship is broken, the firm has to repay the loan, which means that the firm has to come up with money to pay. That's called a liability. Now moving on to assets. There are two types of assets, current assets and long-term assets. Current assets are typically are liquid, obviously, and their life is less than 1 year. And examples are cash and marketable securities, receivables, which typically get paid off within a year, and inventories, which typically get sold off or converted to final goods within a year. And then fixed assets are long-term assets. Typically, their life is exceeding a year. So there are two types of fixed assets: tangible assets, which can be felt, touched, etc., and intangible assets, which are notionally present. Tangible assets can be plant and machine, and intangible assets could be a patent or a trademark or the company logo. These are all intangible assets because they exist, they have a value, they can be sold for money, but they cannot be felt. So the total assets is defined as a sum of fixed assets and current assets, or short-term assets and long-term assets. Now, current liabilities. As we read, liabilities that have a life less than a year typically are called current liabilities. These include payables, which typically are short-term payables, that is, paid off within a business cycle, a smaller business cycle, a short-term debt, which is also paid off. Mostly it is used to finance working capital. And then there are long-term liabilities, which are typically loans taken for over the long run, or commitments that are over the long run. So the total liabilities and owner's equity is defined as shareholders' equity plus short-term liabilities or current liabilities and long-term liabilities. We've already seen what's equity or owner's equity or shares. So owner's equity is the residual part of the firm, which is total assets minus total liabilities. So anything that when we liquidate a firm and we pay off all the liabilities, whatever is left over is called shareholders' equity. And in fact, equity is also called residual ownership for that reason, because that's something that is left over. All right. So, like we said, assets are something that a firm owns, and they represent the use of a firm's funds, liabilities or owner's equity. Liquid assets can be easily converted to cash, or short-term assets, current assets, can be converted into cash faster. And then fixed assets take time. They're long-term in nature, and they cannot be liquidated into cash that easily. For example, a short-term bond can be, if a firm owns a bond, that bond can be sold off in financial markets when the markets are open and converted to cash. On the other hand, a plant and machine takes time to sell. So fixed assets usually have longer term, are not as liquid as current assets. Awesome. Now let's move on to examples of current assets and liquidity. So like we say, a current asset is something that can be easily converted into cash. Aircraft owned by an airline would typically take some time to be converted to cash because we need to find the right price, we need to find a buyer, we need to find, or if not a buyer, a broker or some company that will buy the aircraft, etc. And so aircraft owned by an airline typically is not a current asset. Corporate office space building, same problem, cannot be converted to cash immediately. However, investment in the 30-day treasury bill, well, the bill can be sold off in the financial markets for cash. So which is the least and the most liquid? Corporate office space building is the least liquid. Accounts receivable can be converted to cash relatively easy, but again, not as easy as cash itself. And investment in a 30-day bill is actually easily converted to cash. So investment in a 30-day T-bill is the most liquid, and corporate office is the least liquid. So that's how we can arrange assets, by their ease of conversion to cash and by liquidity. Now, a fixed asset, like we said, could be a tangible asset like plant and machine, or a building, or unsold inventory, or it could be intangible like patent, trademark, logo, etc. And so is an example of an intangible fixed asset is it an aircraft owned by the airline, or is it a copyright to a new movie released by owned by Disney, or a corporate office space building owned by the airline? So this is intangible fixed asset. So intangible could be copyright or a patent or a company logo. So all these three are intangible fixed assets. All right, moving on to liabilities. So let's assume our company issues a 30-day commercial paper to finance its accounts payable. Accounts payable itself is a current liability. Short-term borrowing could be a current liability. On the other hand, long-term liabilities are debentures, term loans more than 1 year, etc. And so the least liquid one of those would be the debentures and term loans greater than 1 year from the lender's perspective. And the net working capital is current assets minus current liabilities. Essentially, in the short run, how quickly can we pay off our current liabilities using our current assets? Now, let us do an example here, because we've talked about too many definitions and terms. So let's assume that we start a coffee shop. We have a cash of $700, and that's all we need to start this coffee shop. So we form a company called Barstux, let's assume, and we fund it with this cash. So currently, this company has a cash of $700 and owner's equity, because it's coming from the owner, that is us, for $700. So total assets is 700, total liabilities and equity is 700. Now let's assume we use the $700 in the next period to buy a machine for $500. So now our cash decreases to 200 and plant and machine goes up to 500. Owner's equity remains at 700. So the left hand side is 700 and the right hand side is 700. The way we get 700 on the left hand side is we add the 200 with the 500. Now let's assume we have the $200 with cash. Let's assume we use $100 of that to buy raw material or inventory. And so what happens now is the cash will go down to 100, raw material will go up to 100. So this should not be 200 but 100, and machines is 500. Wait, we didn't buy this using cash. We bought this using credit. So since this is a non-cash transaction, cash remains the same. But our liabilities went up to $100. So now that has funded our raw material purchase. Owner's equity, the initial cash we provided, remains 700. So the total assets have now expanded to 800, as have total liabilities and owner's equity. So 800 is 700 plus 100. 800 is also 500 plus 100 plus 200. Now let's assume we use 10% of these $100 worth of inventory to convert raw material to finished goods. That is, we use 10% of these coffee beans to make coffee. So now our cash remains the same. Raw material of $100 decreases to 90, and our finished goods increase to $10. Overall size of our balance sheet remains 800. Now, size of balance sheet is also the value of total assets. So it's 500 plus 10, 510 plus 90, 600 plus 200, 800. Since we did nothing on the right hand side, our accounts payable are same, owner's equity is the same, the total liabilities and owner's equity is 800. Now let's sell these 10 coffees for $25. So now what happens is and we sold it for, let's assume, on credit. So we sold off all the $10 worth of finished goods and converted accounts receivable because we sold it off on credit. So this is something that will come back to us when they paid either in cash or something else. So accounts receivable have increased to 25. And so the right hand side looks like this. We have still got accounts payable on our raw material, and we have owner's equity. So total assets is 200, plus 90 is 290, plus 25 is 315, plus 500 is 815. Whereas total liabilities and owner's equity are 800. So the balance sheet is not balanced. So how do we balance it? Well, the point to note here is that we have made a sales worth of $25 based on $10 of finished goods, which means essentially we've made a $15 profit, and that profit goes to owners. Therefore, that is also going to be called as retained earnings. Here, we've just combined it for simplicity into owner's equity. So its owner's equity is composed of two parts. Owner's equity, which is the book value of shares, plus any paid up capital, plus retained earnings, which is accumulated profits over the years. And so now we have the size of balance sheet as 815, and the balance sheet has matched. So 200 plus 90 is 290, plus 25 is 315, plus 500 is 815, as is the right hand side. So we were able to balance out the balance sheet. Now let's assume we remember we had that credit for $100. Let's assume we pay $50 of it. So now accounts payable decreases to 50, and our cash that was 200 has decreased to 150. In short, the entire balance sheet has shrunk by $50 from 815 to 765. Now let's assume we received the accounts receivable that was utilizing line of credit for our customers. So we received that $25 as cash, which means the cash, which was 150, becomes 175. Accounts receivable that was 25 becomes 0. And on the right hand side, there's no change because this is payable. We still haven't paid $50 of our inventory, and owner's equity remains the same. So the right hand side remains at 765, but the left hand side now, significantly enough, has also become 765. Again, the balance sheet has balanced. Now let's assume we want to start a new coffee shop. We saw that, we're making profits with this shop. Let's start another shop for $700. Now here, we've not used owner's capital. Notice we've taken a bank loan, which means our liabilities, not owner's equity, will go up by 700, and cash will also go up by 700. In other words, the cash position, which was at 150, has now become 850, and long-term debt has now been added to our balance sheet at 700. So the balance sheet size, the size of total assets, which was initially 765, has now become 1465 on both sides. And with that, we end the discussion of balance sheet. So in this discussion, we've seen what is balance sheet, how do different items affect the balance sheet, what are total assets, total liabilities, short-term assets, short-term liabilities, how do you identify them, distinguish them. That is Chapter 3, Part 1. Thank you for listening.